The manufacturer's hidden struggles, the cost we must all pay, and what could save us. Last week, we had a slew of economic numbers related to the manufacturing sector. We're going to talk about them, the good, the bad, and the ugly. We're going to talk about the biggest challenge currently to the manufacturing sector, why it's so important to us, and the most important economic number that we should be watching moving forward. The good, industrial production, capacity utilization. Industrial production measures a real output of the manufacturing, mining, and gas utility sectors. Industrial production rose on a year over year basis at 1.6%. That's the best number we've seen since 22. That was at 1.8%. Capacity utilization measures a percentage of the economy's potential output that is actually being used. That also rose. Capacity utilization up 78.8%. That's the best number going back to early 23 at 78.9%. So the 78.8, this shows us that the manufacturing sector is operating at a 78.8% capacity. That's how much they're producing, and that's a good number. On a year-over-year basis, capacity utilization actually rose into positive territory for the first time since mid-22, up 0.2% on a year-over-year basis, compared with that prior number of 0.8%. The bad, Philly Fed Manufacturing Index. We can see it's broken down into several sectors, and the theme we see here is consistent throughout. On the top, inventories down 9.4, work hours down 1.6, prices paid up 19.8. What's this telling us? Well, prices paid represents the prices that the manufacturers pay for the raw materials. They use the raw materials to make the finished goods that we consume. So there's inflation at the producer level. The raw materials cost more to the manufacturer. Now, the manufacturer can either pass on these extra costs to the consumer, but we know that's not happening from last week's CPI, PPI reports, which, by the way, we're also going to show you the parallels between. So what does a manufacturer do? They sell off their inventories. If they can't raise prices, they get rid of excess inventories to help their corporate profits. That's why inventories are down. So when we see prices paid up and inventories down, that shows us the corporate profits are being squeezed. And by the way, another way to compensate for that lack of profits is by reducing work hours. Now, the ugly. Empire State Manufacturing Index. Empire State Manufacturing Index shows us the same theme. Prices paid. Again, the cost of raw materials, 26.5. Average work week down, negative 0.1. Number of employees down, 7.9 to the negative. So same situation. They're reducing the work week and the number of employees to compensate for the fact that they're losing money because the price is paid. The raw material prices are higher. And by the way, their inventories are also down, negative 6.1. This also shows us they're selling off the inventories to compensate for the lack of profits. Now, what does the Empire State and the Philly Fed have in common? Prices paid goes up, inventories go down. Take a look at the similarities. In red, that's Philly Fed, which, by the way, represents manufacturing in the Philadelphia region, roughly, and the Empire State, that's manufacturing in the New York region. What do they have in common? Inventories down, prices paid. And it's pretty stark, the difference between the two. These are some of the best and worst numbers we see across all the different segments. It's really no surprise and no accident that both of these manufacturing barometers derived from different regions are showing us the same thing. Now, what products are manufactured in each respective region? In the Empire State, well, there's lots of different products, but primarily pharmaceuticals, electronics, apparel, and machinery. Keep in mind, the Empire State's a little bit in worse condition than the Philly Fed region. Philly Fed, chemicals, metal and steel production, medical devices, aerospace, and defense. We've seen other numbers that do demonstrate strength in the aerospace and defense sectors. Maybe that's why Philly Fed looks a little bit better than the Empire State. Now, why is this so important to us? Inflation at the producer level, meaning prices paid. That weighs on manufacturing. We've seen this. They have to cut work hours. They have to cut, the average work week and overall employment as well. They're selling off their inventories. They're putting manufacturing in a tough spot. In blue, that's Empire State Manufacturing, prices paid. In red, Empire State Manufacturing, average work week. We can see these figures are going in opposite directions. And this is going back several years. This is quite a bit of data. Here in blue, Empire State again, prices paid. In red, this time, number of employees also moving in opposite directions. So when the cost to the producer goes up, the producer has a little choice but to either raise costs to the consumer or cut the number of employees, cut the average work week. So, which economic number should we be watching moving forward to anticipate some sort of a reversal? And again, this is important to all of us because we see the average work week is down, the number of employees is down, as well. So this weighs on the overall economy. We can see this ripple effect, work itself out to the housing market as well. If we have less work hours, we can afford less real estate. And we can imagine what other repercussions are there within the economy. So what number should we really be watching? The PPI, Producer Price Index. Now, last week we had great numbers in terms of the CPI going down, Producer Price Index, not so lucky. In blue here, Empire State Manufacturing Index, it's rising alongside PPI. And the Empire State Manufacturing Index, that specifically prices paid, that reflects the inflation at the wholesale level. And we can see here, PPI, Producer Price Index, on a year-over-year basis, also rising. There's a loose correlation, but it does make sense why both numbers are moving in the same direction, which certainly they are. Now, we spoke about this in greater detail last week, specifically, why is everything getting more expensive? And it's called cost push inflation, where essentially the inflation is created in this sense, it's being created at the producer level. The producer has no choice but to pass on the extra costs to the consumer. But it's not a one-to-one relationship and it's not immediate. There's actually a lag. We went into the data and there's actually really interesting the results. We see approximately a 5-month lag within the data between a hike in PPI and a hike in CPI. And in this report, we take you through the details of the data and show you exactly how it works. We hope this has been helpful. We look forward to seeing you back soon.